Hello and welcome to Crux Investor. We caught up earlier today with Mark Gray. He's the CEO of an ASX coal company called Allegiance Coal. He's actually based up in BC. We talked to him today about their imminent production from their Colorado project. If you want our thoughts on the conversation topics covered today, including the macro, go to our website, cruxinvestor.com/club, where you can also find detailed company reports and analysis, which you might enjoy. There is commentary from experts from around the world on a variety of companies and commodities. We do training videos on there to help you with your diligence. We also do summaries of other interviews that we've done just to save you some time. And of course, there's a wonderful, thriving community of quite intelligent investors sharing their thoughts and ideas with each other and discussing the content in there. Go and join them at cruxinvestor.com/club. And of course, we'd love your feedback too. So why don't you give us a like? It'd be appreciated. And of course, if you want to leave your comments below, we get back to absolutely everyone. And we also have a full description below of all the topics discussed in the conversation today. Mark, how are you, sir?
Well, thank you, Matthew.
Good, good. Where in the world are you?
I live in a very cold place, northwest British Columbia, at the location of one of our projects.
Oh, fantastic. No, you don't sound like you're a local. Where are you from?
Originally New Zealand. Spent a lot of time in Australia over the last 15 to 20 years learning the mining game as an ex-lawyer. But resident in Canada now for the last 3 years.
Oh, fantastic. Okay, right. Well, so it looks rather cold there. It must be also must be a little bit different from what you're used to, I suspect.
Certainly, the winters here in northwest British Columbia, can be quite demanding. At the moment, it's about minus 20, 21. Yesterday, it got down to minus 31. That is extraordinary. Normally, we live in temperatures, around minus 10. Lots of snow. We have a ski hill very close to us, so recreation here is particularly good as well.
Oh boy, that is. I'm not sure I have clothing for that, but that sounds very, very cold indeed.
Sorry, it certainly poses interesting challenges to mining, right, in the cold weather. But to the credit of Canadians, they're good at it.
Well, look, we're about to hear all about it. But before we kind of get into having our discussion, would you mind giving everyone just a 1-minute overview of what your business is, and then I'll pick it up from there.
Yes, Allegiance Coal, ASX listed, focused on developing and operating steelmaking coal mines. Strong believers in the long-term demand for blast furnace steel.
Okay, great. Very concise, very lawyerish of you. Well done. Now, we wrote an article on coal a couple of weeks ago, and boy, oh boy, we were absolutely abused by a few people who are a little bit upset about the idea of people mining coal. It's dirty, it pollutes, it's not good for the environment. So why on earth would you want to be a CEO of a mining company which is bringing coal out of the ground?
Very good question. I'm personally a strong believer, as I said at the beginning, in the immediate, medium, and long-term demand for blast furnace steel. Supply is constrained. During the last commodity downturn, a lot of the major coking coal producers held back on significant capex programs, and it takes 10 to 15 years to get a mine into production. So supply is constrained, and demand is good. India is slowly but surely going through a significant industrialization process, and China's demand for coking coal remains strong. They're a net importer, notwithstanding how much coal they produce. So the macro economic dynamics tell a good story. And at the end of the day, you do need steel to make wind turbine energy, solar panels, electric cars, long-term storage, battery units. I mean, it goes hand in hand with renewable energy.
So do you think people are getting confused, the difference between thermal coal, which is for energy requirements, and met coal or coking coal or steelmaking coal, however you want to phrase it, which has industrial usage? If you're making steel, you need met coal. So do you think that's the confusion? Is that the problem in terms of environmentalists getting angry with coal miners?
Well, certainly there is no doubt about it that there is a lack of knowledge in making that distinction. And I experience that every day. I'm some very intelligent people who I come across every day, every week, every month, who are surprised to appreciate that thermal coal and metallurgical coal are two very different minerals. One serving power and the other, serving the blast furnace steel industry. Of course, you can always put metallurgical coal into a power station. It's like putting, it's like rocket fuel for a power station, but you can't do the reverse, right? You cannot put thermal coal into a coke oven and a blast furnace.
So it's one, again, I want to deal with this because, we get questions sent in all the time from all around the world where there's this misunderstanding. So thermal coal has what? It's more polluting. It's got more, it has different side effects in terms of the environment versus met coal. What's the difference? I know the different uses, but what are the different outcomes when you use them?
Well, they have, they have different chemical properties. Metallurgical, it still has ash, it still has sulfur, as does thermal coal. But in the coking process of metallurgical coal, we extract those impurities in the coke oven, so that when we put pure coke, pure carbon into a blast furnace, a lot of those polluting properties have been removed. Okay.
Right. So I think we need to do a little bit of digging, and we might help people and point in the right direction in terms of just getting the understanding right there. You want us today to focus on met coal, metallurgical coal, coking coal, steelmaking coal, and what you're going to do. So let's start off and try and understand a little bit about you. So what's your background? Have you been in the coal game long?
18 years. I've been involved in running, originating, promoting mining companies, in particular coal. But my first career was in law, M&A law, in New Zealand and London. I spent 8 years working for a Magic Circle firm in London, investment banking in London as well. And in the late 1990s, I decided to do a career change, and by no good planning on my part, I ended up, in the mining industry, and came to own a underground coal mining services company in Australia, along with two of my partners in one of the projects that we are launching, and came to learn about mining and ultimately running mining companies, and came to learn about the coal business and appreciate how important, how critical steelmaking coal is to the world, to the industrialization of the world, and, as I said before, the role that it has to play in renewable energy as well.
Okay. Look, I want to get into your business plan and why you set this up. What is Legence all about? But just you've hit upon some of the touch points I want to talk about now, which is what's happening in demand from India, demand in China. It's a net importer of China. Obviously, everyone's, I think, aware of the spat between Australia, world's largest producer of coking coal, and China, the world's largest consumer, and what that's doing to pricing. Is that slightly distorting people's perception of the opportunities in the market?
Not at all. People certainly who understand the market and the basic fundamentals of of supply and demand in this sector, and are not turned off at all by the conflict between Australia and China. And certainly in the last couple of weeks, the world order in terms of coal pricing and how it's priced has returned, after an odd scenario, in the early months of January, when it became, well understood that China had indeed posed a ban on Australian coal, amongst other things. But the current demand is driven by India. India is slowly but surely working its way into a industrialization program, and the analysts have been unsure and uncertain about when this was going to transform, when it was going to happen. We all knew it was going to happen because of the poverty that exists in India, but when was it going to happen? And it is happening. India is now the largest importer of seaborne metallurgical coal, followed by China, who is still a net importer, notwithstanding the enormous amount of domestic production.
So what can we expect to see with regards to the supply versus demand situation? Because the pricing is slightly distorted now. We're seeing prices out of North America which haven't been seen in a long time, because China's having to find alternatives to this Australian supply issue, which they've cut their nose off to spite their face, it seems. So is that sustaining? I get the prices coming back, and you're painting the picture that the demand story is very, very positive. But is it a kind of synthetic situation, or can you see the pricing continuing as it is for some time into the future?
I'm not too sure that that the comment that you made is accurate. Certainly, for about a month, as I say, the world order of pricing, of metallurgical coal is all against a benchmark coal or benchmark set of coals out of the Bowen Basin in Queensland. There are mines there, namely Peak Downs, Riverside, and a handful of other ones, and they set the pricing for all metallurgical coal on the seaborne market. Now, certainly during the month of January, the benchmark, was trading at a significant discount to other metallurgical coals, Canadian and US in particular. But world order has returned, and benchmark, what we call premium low vol, hard coking coal from Australia, is now again setting the price. US and Canadian, US, what we call US high vol, hard coking coal, trades very closely to premium low vol, to benchmark. I think over the last 7 years, the discount is something in the order of 2 to 4%. And at times, high vol A will trade at a premium to benchmark. So US coals, historically, certainly the high vol A coal, is aligned very closely to premium low vol. So it's not as though the US had a period of high prices. It's rather that premium low vol, because of the Chinese and Australian conflict, depreciated very, very quickly for a very short period of time. But US high vol A is an excellent coal, highly sought after by the steel mills, and a premium is paid for it.
Right, and yet we saw in the US an 8% reduction in last year's numbers. Was that down to COVID? Was that down? Because we listened to, these Trump supporters talking about Trump being there to support the American coal industry, yet production is down. So what is that a factor of?
Matthew, it's pure economics. The US are historically a high-cost producer on the seaborne market. 320 million tons of metallurgical coal hits the seaborne market every year. The Australia accounts for about 65% of that, followed by the US, say 15%, and Canada, say 10%, and then there's the rest of the world. The US, unfortunately, for several reasons, is one of the highest cost producers on that in that market. So they're at the top end of the cost curve, and we often refer to the US as a swing supplier. Prices are up, they come online, they back into production very quickly. When prices decline, they disappear. So what you saw in a reduction in US exports of met coal was directly related to the drop in the benchmark price during COVID.
Gotcha. Okay. And we notice also blast furnaces in Europe firing up again. That's got to be good for demand. Got to be good for pricing.
Absolutely. Yeah. I mean, it certainly makes me feel warm and fuzzy. The European steel mills idled many of their blast furnaces during COVID, and so did India. But they're back. They're firing up. They're looking for coal, and there's not a lot on the seaborne market. With the decline in US production, as I mentioned before, there's a hole on the supply side, and Europe is screaming for coal at the moment, and they're having to export it from Australia because, of course, Australia can't export to China, and so they have to pay, a big premium to get that coal all the way around the Cape and into Europe. And India also, their blast furnaces are starting again. So the demand out of Europe and India is very, very strong at the moment.
So we're going to need some near-term producers, aren't we? Is this time to talk about Allegiance Coal?
Exactly.
Right. Well, let's do that. Okay. Why don't you tell us what it is that you got? Because you are a near-term producer. You're talking about being, I think we're talking about mid-year cash flow. So let's talk about what you've got, and then I want to talk about how you managed to put it together and what it is that you're trying to build. So if you don't mind, just maybe get into the assets, where they are, and maybe some of the numbers associated with it, and then we'll get into the why and how.
Yeah, sure. Two projects. The Canadian project here in northern British Columbia, northwest British Columbia, where I live. Greenfields project, but very, very close to permitting. And last year, I completed the acquisition of an idled coal mine in southeast Colorado with a very large resource base. And that's the asset which we are working very hard to return to production. Target date, May, June this year.
Okay, mid-year. So give me some of the numbers, because I've written a few numbers down here. 673 million tons, and it's permitted. You did allude a second ago that around US met coal, it's around the economics. So what can you tell us about the numbers there at New Elk?
Yeah, New Elk is a big resource, certainly by US standards. The mine itself has 670 odd million metric tons of coal resource, the vast majority of which is in the measured and indicated category. It's a very high level of resource definition. I undertook a feasibility study in relation to one of the 8 coal seams last year, and converted about 45 million tons of that resource into saleable coal reserves. And that's just the tip of the iceberg. A resource this big, you can't plan how you're going to mine it in a couple of months. It's something that you're continually working on and reviewing. So substantial resource base, got a solid reserve base to start mining with that asset. What are my costs to load it on a vessel in the Gulf of Mexico, which is where we will take it? Our feasibility study indicated that we could load a vessel in one of the coal terminals in Houston for something in the order of $75 per metric ton. Alternatively, I can rail it a little bit further to the coal ports in New Orleans, for the price of around about $80 per metric ton. So these are, I mean, in terms of cash costs, these are very low cash costs on the seaborne market. It would puts the mine certainly in the lowest half of the cost curve for seaborne metallurgical coal, and on the tip of the lowest cost quartile. So I feel very good about our cash costs.
Okay, so that's cash costs, but help us understand, just so people can do some quick maths in their head, is like, what is that selling for at the moment on the open market?
So the product that we will be exporting in the coming year will be very close to on specification high vol A. So it's a premium coal. Today, high vol A is trading at last glance around $150 US per metric ton. I would be hoping to get something very, very close to that price, with our first shipments.
Okay, fantastic. So right, we've just done some maths in our head. We now need to. It's permitted. You've done
fully permitted, and I might add, fully constructed. This mine was built in 1951. It operated for 30 years, producing 30 million tons of coking coal supplied to a blast furnace which existed in southern Colorado for over 100 years, and also supplied coking coal to a blast furnace in California. So it's a constructed mine. If I was to build this mine today, it would cost $200 million. My startup capital requirement today is $13.5 million US dollars.
Okay, so 13.5 million gets you a refurbished operating mine, fully permitted. What else do you need to do between now and May, June this year? Not just in terms of cash, but in terms of skilled labor force, getting equipment in there to be able to start a process, and anything else that you need to be able to get it free on board?
So my management team is mobilized. They're on site now. The chief operating officer of the mine has moved there with his family. We have engaged our production manager, our general manager for non-production activities. Those are the two key executive positions on the mine. Those people are in place. We are currently refurbishing the mine equipment that we have on site. We need to buy some extra pieces of equipment. And we're refurbishing the mine generally, small upgrade on the wash plant. But all of that will be done by the end of March. It's not a big engineering exercise. It is primarily refurbishment. And on the sales side, my sales and marketing agent, I use a firm out of Brisbane, Australia. They are engaged with the steel mills globally, and we are starting to build an order book. So it's all very imminent.
What the deadline is. There's quite a lot of moving parts there. So just on the cash front, you raised, I know, $7.5 million back in November. But are you sitting on enough cash at the moment to actually do all of this?
So no, I'm not. I'm using that cash to do the equipment refurbishment and mine refurbishment as we speak. But certainly, I will need more money to continue that CapEx program. I mean, it's not significant. The total capital expenditure requirement out of that 13.5 is 10 million. And the other 3.5 million is working capital to get into production. But I'm very advanced in discussions and due diligence with the New York Debt Fund for a $15 million project finance facility. Technical due diligence is largely completed. No real issues out of that due diligence. The independent technical mining consultants felt that the mine plan that my consultants had developed was robust. Our OPEX costs, CapEx, production assumptions. So that's a real positive. And the debt fund is now moving into legal and financial due diligence. So if I'm successful in securing that funding, that will be the greater part of my capital requirement secured. So I hope to do that by mid to late March.
Okay, so your market cap's around 80 million. Share price has been fairly, let's call it flat-ish over the course of the last year. You want to do it in the most non-dilutory way possible for your shareholders and probably yourself. You're quite a significant shareholder too, over 3.5%. Those conversations with traders in Brisbane looking to do your marketing, your sales effectively for you, are you going to need a piece of paper from them to go to your debt guy in New York and say, hey, look, I've got forward sales, I've got an offtake or whatever the agreement looks like, to be able to get the debt guys over the line? Or are they going to have a massive security on your asset to be able to provide you the debt that you want? Because this swings and roundabouts here about how you come at it. You're a lawyer. So you're going to want that as tight as possible, but also answer the question of how do you do this in a non-dilutory way. So what are the options you're looking at?
So offtake financing will not be a condition precedent to the funding. The coal quality is well understood. It aligns very nicely with high vol A coking coal on the seaborne market. It's a very liquid product. It's highly sought after. It's in demand, particularly so in the current environment. So, offtake finance is not a condition to the funding. This is, typical project finance. So the debt fund will be our senior secured creditor.
Okay, fine. Okay, and you'll try to do what? Make sure that some of those conditions fall away over the course of repaying that loan?
We're looking at probably a 3-year term. 12-month interest holiday, and start repaying debt over the last 2 years. I think that's the type of facility that we have discussed. I do have a term sheet for it, subject to the completion of DD. So all the commercials have been agreed.
Beautiful.
Subject to diligence.
Okay, I guess what I'm getting at is over the next 3 years of the term of this loan, will you be needing to go out to market to raise further capital, and if so, I guess what for, and will this affect your ability to do that?
I think once the market knows that I've secured this facility, or is comfortable that they can see that I will get this debt facility, that they will see that I have a clear pathway through to production, and I'm hoping, one can never forecast what's going to happen in the capital markets, but I'm hoping that the company will be re-rated as a consequence of that. It really, in my mind, is the barrier to reflecting the true value of the company. We have a market cap of slightly less than 80 million. Yet, by the end of this year, we could be on track to, depending on the coal price, to achieving, an EBITDA of 75 million Australian, on a multiple, or say a 4 times, which is quite typical for the coal sector. That puts a market cap, comfortably over 200, nearing 300 million. So that's a big gap from where we are today, and that's potentially less than a year away.
No, the opportunity is clear if you can deliver all of those things in the sequence and timing that you say. Absolutely right. Are you slightly frustrated the way that coal companies are valued? The multiples can be 4 or 5 times, and then sometimes they just sit there, these wonderful cash producing machines, but the big funds don't want to go near coal, met coal or otherwise, because they possibly don't understand it, or at least their shareholders don't understand it. And you're seeing this trend away from coal generally. Is that frustrating?
Not really. I mean, there remain very strong supporters. The retail sector continues to invest very heavily in companies like ours in the met coal sector. Micro fund managers continue to do it, family offices. There is a wonderful source of capital if you can attract it. I think what I see has happened, since perhaps the last coal boom during the 2010, 2011 years, that coal mine operators and CEOs like myself are focusing a lot more on generating cash flows and paying dividends. I think historically, coal companies were looking to take the retained earnings and make acquisitions and grow the biggest coal company, this side of Queensland or wherever, and they were focused on capital growth, on share price accretion, which is a wonderful thing, but less focused on actually the fundamental of paying a good return to your shareholders. So my strategy is to generate strong earnings, focus on organic growth. I mean, I have a huge resource base. I have 2 projects, and the New Elk is a very significant resource base. And the organic growth that I can achieve from that asset, rather than having to go out and acquire other assets, is significant. So I want to get strong earnings and pay returns to my shareholders.
Yeah, it's interesting. Actually, you say a couple of points there is that I think the roadside is littered with some train wreck M&A activity where people are paying hundreds of millions, if not billions, for coal assets, and then they've forgotten that we need to make money. So I think some good examples of that. But also the interesting thing is about coal companies is this sort of certainly analysis we've done that the dividends are high single digit, if not sometimes low double digit type dividends. It's extraordinary.
They really are. They are, and in my engagement and conversations with fund managers, that always comes up. How committed are you to paying dividends? They want to see, annual returns on their investment. They're not sitting there just watching the share price perform every month.
Yeah,
I'm committed, very committed to that strategy. And as I said before, we are lucky because we have such a massive resource base that the organic growth that we can achieve with a single asset is very significant.
I'm glad you said that. So there's a kind of I know we manage money our money ourselves. The ATM component, right? These high single digit, low double digit dividends is very attractive as a steady income, and whatever happens to the equities happens to the equities, which usually it's the other way around. We think of lots of industries which will pay 1% or 0.5% and feel quite pleased with themselves. So I think it's interesting, definitely worth people investigating further and looking at. And I was going to talk to you about the strategy, but I think you kind of laid out there that you're not going to be going after a crazy M&A component. So in terms of fundraising, dilution further down the line, that's not on your agenda at all. So New Elk, we understand the timing of it, and obviously you're up in BC at the other asset. So what's the timing on that?
So I've got a very strong management team based in New York. So I'm very comfortable sitting here in Northwest BC and engaging with them, every day via this platform. But with my Canadian project, we're very close to filing what is called an environmental assessment certificate for that asset. That activates a 180-day review period with the regulators here in British Columbia, and that leads to a 40-day decision period by the Ministers of Environment and Energy and Mines. So hopefully by October, November this year, we'll have our environmental certificate for that particular project, and that is the mountain to climb. So that asset is not very far away from being permitted and being into production. So I'm thinking possible construction in mid-2022, first coal 2023. So that would add very nicely to our production in New York. Incremental, increase in production, from one of our assets.
But here's the other aspect to that. That's saying it and it happening are two different things, right? Because, as I said at the outset, the amount of abuse we got just for writing an article which was, remotely positive of coal as an investment. Okay, you are up there, and you've got not just your EIA to approve. You've got to get the locals on board. You've got to get their permission. And with this First Nations there, you've got to work with these people. So what are you doing about that? Because applying for stuff on paper and having people standing at your gate stopping anyone entering your property, these are all considerations. So how do you manage that? How do you develop those relations?
Well, the best way to do that is to, as a company, is to send your CEO there, make your CEO live there, and engage with the community in a real way. Don't come and do 6 monthly visits and present to the local community in a hall. Come and live here. Come and engage with the community. Let them have what they want to say. The buck stops with me, and the locals understand that, and they're very appreciative of me being here. So I've been here for 3 years, and I moved here when we commenced the the pre-application phase of the environmental assessment process in British Columbia. The local community are hugely supportive. There are isolated pockets of opposition, and that is acknowledged and accepted. But overall, the local community is hugely acceptive, subject to 2 provisos. Do not prejudice the water in the rivers and the fish habitat in the rivers. And that comes down to science and engineering. And if we can't satisfy the BC regulators and the local First Nations group that we can do that, then we have not achieved our social license, and we will not get our environmental assessment certificate. So it comes down to, as I said, the ability of my team to develop a mine plan, mine design, which has minimal impact on not only water and fish habitat, but all the other environmental, components, and that's what we're doing. And I can say that, given how close we are to lodging our EA application, that we're feeling pretty good about the results that we have now.
Okay. Well, let us know how you get on with it. I think it's really, really important. What you say is really important. Sometimes it's not just about jobs. It's about doing things the right way and making, if it takes a little bit longer, so be it. So I appreciate that.
Exactly.
We as investors, we want to look at where the money's coming from. So as far as you're concerned, New Elk, that's what we should be looking at. Timing you've outlined, May, June this year, cash flowing, and assuming everything else comes together at the same time. Mark, I love it. Appreciate your time today. I know it's freezing there. Hopefully not inside. You should stay in touch with us. Let us know how you get on. Sounds like there's a succession of announcements that you'll be making over the next few months. So we'd love to hear from you. And so do pick up that phone and let us know, okay?
Thanks for the opportunity, Matt. You're absolutely right. We are 3 to 4 months away from production. We've got a big resource base, a big reserve base, a wonderful asset, good coal quality. We'll be producing, by the end of the year, up in excess of 1.5 million tons annualized. The company really is in a strong position, and it comes down to execution. I've got the management team to do it. Thank you.